Hey, what's up, investors? Today we're going to be talking with someone on my free Zoom chat mentorship series. Someone from the channel reached out to me and has a property already, has a little bit of money saved up, and wants to buy a second property. And they're asking me what should they consider. And I'm going to be talking about how to do it safely, the most safe, and there's a reason for that. And also giving them advice on how to tackle the monetary part of this, because unfortunately, their money really isn't going to matter at all. It's not as much as they think it will. And it's the reason actually even millionaires and billionaires still raise money. So we go into all of that in this. And if you have any questions that you want me to answer on my free mentorship with the Zoom chats, go on my website at devinmorenoinvesting.com, and there you can sign up on my calendar where you can pick a day to have a free Zoom chat with me, and as long as you're okay with it being posted on this channel. So without further being said, let's go ahead and get into it with this chat with Jamie. So just to make sure I fully understand all the parameters here, I'm going to go ahead and recap them really fast. But essentially, you have one property already. You're looking for your second property. You're looking to do a renovation, it sounded like. You're looking to actually renovate, not something turnkey. You actually want to renovate and maybe add value to the property. Am I correct? Okay. Well, plenty of opportunities for that in Baltimore, obviously. So, and you're kind of looking, you said earlier you wanted the Druid Hill sort of neighborhood. So you're sort of looking at what I would say like a Class C. Are you familiar with the class structure in the United States as far as how properties are in neighborhoods are classed out?
No, I am not.
No, you're not. Okay. Real quick. It's super easy, but Class A is going to be like, this is simplifying it grossly, but like, let's say mansions. Class B is going to be upper middle class, generally people making 100,000 plus, simplifying it grossly. Class C is going to be your average American, sort of 60,000 to 80,000 sort of range, median income, maybe 40, going probably as low as 45,000. And then Class D would be everyone who falls under that mark. Druid Hill is kind of bleeding into that sort of Class C, Class D, sort of depending on where you are. That's kind of how Baltimore is, block by block. So, so basically, you're looking at trying to get one of the, I'm going to call it a more median average home price in Baltimore, probably your $150,000 home-ish, maybe not by that specifically, but something that would have an ARV of that. So you're not trying to get something with an ARV of like 400 grand, I'm assuming, right?
Correct.
Okay. So then, all right, then as far as where I would go. So after your first property, first off, the big question is, are you subsidizing your income in that first, I'm sorry, your mortgage in that first property by renting rooms or another section of the house?
No.
No. Okay. So we always have to keep in mind of the existing like payments that you have before we buy a second property. Let's say you're in a situation where that second tenant isn't paying, then believe it or not, your first 2 or 3 or 4 houses are your most risky, because that is when you have the least amount of income to prop up multiple different houses. So let's say that second tenant stops paying. Let's just throw that out there. And this is just going into our future mindset of how we're going to buy this. If they stop paying, you're paying your current mortgage plus the new one. And if the new one was, let's say, $800 a month, would that put you in a financial burden if you had to pay for both at the same time? Now, you may not have to answer that question, but if the question is yes, then this is the reason I say a lot of times I often promote trying to pick a very safe house for your second one, especially if you're still paying the mortgage on your first. Now, a lot of people might ask, okay, why wouldn't you pay the mortgage on your first? It's usually, like I said, they're house hacking, which by doing that, oftentimes they're not paying any rent or any mortgage on where they currently live. And that allows them to fund the second house safely, because if this tenant stopped paying, then, you know, you can easily do it. So now the tenant not paying can happen mostly because you're still new to tenant placement, I assume. Do you consider yourself like an expert replacing tenants and such like that?
Not at all.
So then we have to assess for that variable that it's possible that, especially if you don't hire someone to do it, it's possible you may end up accidentally picking the wrong tenant. So we just try to make sure you have the biggest safety net possible. This is oftentimes why I often promote duplexes. You're going to find a lot of duplexes in Druid Hill, but if you can find a duplex, the reason I like those is because, one, they cash flow way more than your traditional single family home. Are you aware that a single family home, when I say cash flow, that means after the mortgage is paid, after the maintenance, after the vacancy, after the capital expenditures, all of that is allocated for, you're ending amount of money that you receive is your cash flow. So not necessarily profit, because profit has nothing to do with the allocations, but that cash flow is about $300 per door. Were you aware of that single family homes really only make that much?
No, actually.
Yeah, it's a lot less than a lot of people actually think. A lot of people believe it's revenue minus the mortgage, and then
This makes it more important that
that's your Vegas money.
Build a lot of property before you actually start making profits.
Exactly.
Right? You're saying you need a good portfolio and a mix.
Exactly. And so, but when you're starting out, we try to hedge a lot of that risk. And that's where, if you're going into that Druid Hill neighborhood, I would recommend, if you can find them, duplexes. They're often priced the same as single family homes, are very similar. And not only that, but they double that amount of cash flow to like 600. And they insulate you from the risk. If one tenant stops paying, the other one might still be paying. And on my YouTube channel, I went through an eviction on my second house, and it saved me that the tenant upstairs was still paying the rent, despite that the one downstairs was not. So under the best of times, you're cash flowing a lot more than usual. And under the worst of times, well, you're generally pretty protected. So if you can go toward a duplex, then that's what I would do. But if you can't, all right, and let's say you just prefer a single family home, and that's just what you found, and that was what worked out for you, then I usually would stick to one where you can maximize the amount of bedrooms, maybe 3 or 4, probably at minimum. And the reason why is because if you want, you can go for Section 8, and that'll kind of give you the maximum value, because they go by bedroom count. More bedrooms is always better. So I would avoid like your 2-bedroom houses. You're not going to have too many residents going for that. And maybe having a 5-bedroom would be fine, but generally in that area, you're probably looking at more 4-bedroom houses. Okay, so we have that down. Now, earlier, before we got on the call, before I move forward, we now have kind of like the targeted thought. Try to go for a duplex, but if not, we're going for maximum bedroom count, maybe 4. Try to stick toward that number. And then as far as the renovation level, do you have a lot of experience in construction?
No, but I'm familiar with the process. But yeah.
Do you have contractors whom like you can absolutely rely on?
No, actually, I don't.
Okay, not a problem. I usually at this point would promote my own services. I actually started a contracting company to help, but I found myself way overbooked. And so I'm not even sure by the time that happens, but we'll find out. But basically, if you do not have contractors at your disposal, you do not have anybody you trust, the number one area where a lot of new investors get hemmed up in the real estate process is contractors. It's actually not usually the tenants. It's the contractors kind of being unreliable, let's say. It's mainly because they can find out in about 5 minutes or less whether or not you know what you're doing. I do cover it in videos on how I deal with contractors, especially as a new investor, because I have had my fair share of scams. I've kind of learned how they operate now at this point.
The good ones and the bad ones, yeah.
Yeah, exactly. And it is very difficult to find the good ones. It is very, very hard, because oftentimes the good ones are tied up with work for a long time. They're usually not available as much. With that being said, the reason I bring up all that is I would focus on more of a cosmetic renovation, something where if you're not doing what I call the 3 rough-in trades, that's you're not messing with pipes behind the walls, you're not messing with electric behind the walls, maybe surface level stuff, painting, flooring, just to kind of get yourself familiar, get yourself a relationship with a contractor where it's not going to be this really grueling task. If you get the wrong contractor, it is so much more painful if you're doing, like, let's say a gut renovation, which I absolutely would not recommend for a new beginning investor.
Yeah, that's definitely not the HGTV dream that I want right now. It's mainly just, something light and easy.
Exactly. And so perfect. So we have that all out the way. We know kind of what you're going for. We know if you do a single family, you're probably going to want to do a voucher tenant, especially in that neighborhood. And because there's going to be so many of them, and especially if you renovate it the right way, you make it look really nice, you're going to attract a really great voucher tenant. So it's kind of a myth that voucher tenants live in like horrible houses. They actually don't. A lot of them live in very nice housing. They have a lot of demand. So let's go into now acquiring this property. So let's say you have $10,000, and it really doesn't matter. If you know from my channel, I actually started only $500, so you don't really need a lot of money to do this. It's not really going to matter what you start with, because, and I'm using 10,000. I know you gave a different number earlier before we started recording, but let's just use that for the sake of this video. With $10,000, let's just say you used a hard money loan and you got 80% of it funded of the purchase price. All right. Do you know how hard money loans work?
No, I think you mentioned it in one of your videos, but I completely forgot.
Not a problem. Here's what I want you to do. Actually, if you write this down, the Maryland Investor Network Facebook page. All right. That Facebook page is going to bring you to a lot of contacts that you're going to need starting off in Baltimore. I know it says Maryland, but it actually started off as the Baltimore Investor Network. All right. But now they changed it to Maryland Investor Network to be more inclusive, but it's mostly Baltimore residents. And so it's investors, contractors, realtors, but it's also hard money lenders and hard money lenders who are local to the area. And that's really important because a lot of Baltimore houses have these things called ground rent on them that a lot of outside lenders are not going to understand. So you do usually want a local lender who understands how this city works. Personally, I have used Trias Lending. So if anyone wants to use them, I've had pretty good success with them, testing other ones currently, but you're going to find a lot of good ones, a lot of them local. Dominion Lending, there's Pimlico Group, and such like that. You don't have to memorize all of it right now, but normally what they'll do is they'll give you 80% of the cost to purchase the home up front, and then they expect you to fund the other 20%. Now, if the home is $100,000, well, then you need 20 grand. So obviously that's not going to work. So you realistically need like a $50,000 home in order to really make this work on that $10,000. So you're going to find very quickly that having like only 10 grand, which a lot of people don't even have, to be honest. So, but only having that amount of money is going to be very, very limiting. And so you're going to find then, okay, so what do you do in that kind of situation? You'll notice that millionaire and billionaire investors like Grant Cardone, Ryan Pineda, Kevin Pathrath, all of them, they are not using their own money for real estate. In fact, it's often considered a bad idea because no matter how much you have, it won't be enough. In fact, one of my partners is very well off, has a lot of money. And even they started noticing they were going broke very fast using their own money. And that teaches to a lot of people who have way more. Like there's some students I have with $300,000 and they notice very quickly it burns very fast. And so what you actually need to find is what we call transactional lenders or gap funding. And that is found by private lenders. So the hard money lender, or even a bank, by the way, a bank's going to do this too. All right. They'll fund what? 80%, you got to put 20% down, right? As an investor. Well, that other 20% usually comes from a private lender. This is actually how I started off. I had friends with 401ks, not rich people. All right. So you don't need a bunch of rich people in your network. I don't have any. But you need people with 401ks or retirement accounts who are able to dip into that, or even maybe the stock market right now, because right now is a great time to find private lenders because a lot of people's stocks are panicking because their money is going down pretty fast. So they would love to pull it out and make a consistent 12% on their money. Now, this conversation needs practice, all right, because private lenders are different from hard money lenders. Hard money lenders lend based on the deal. So they look at the deal. They don't pay too much attention to you. And they say, yep, the deal's good. I'm willing to lend on it. But private money lenders, they don't lend based on that. They don't care about the deal almost at all, actually. In fact, most of the time, they don't even understand how to do the deal. They're lending based on your personality, on you, your knowledge. And that's why it's so tricky. That's the part that's the hardest part to teach on YouTube is you have to find people within your network whom have money available and are willing to give it to you in the tens of thousands. And sounds daunting. Sounds like, how the hell do you pull that up? But this is where it really depends on your knowledge of real estate. So normally I would get good at a couple different things to have before having that conversation. Number one, do you have a pro forma spreadsheet to analyze deals? Do you have one of those? If you don't, that's fine. All right. I didn't have one starting off, and there was all these investors with their pro forma spreadsheets. I have one on my website that I have that you could purchase if you would like. It's on devinmorenoinvesting.com. But you can get a lot of free ones out there. Okay, mine is just built complex to make sure it analyzes it correctly. But there are some free ones that are a lot smaller, a lot more kind of simple. But all it does is allow you to analyze the deals. Now, the reason this pro forma is important is because it makes it look like you are more competent in what you are doing. It also helps the hard money lender have faith in you too, because they could reject you based on your knowledge. Okay. So, and even a bank. Now, a bank won't look at your pro forma, but hard money lenders will. And so by you having this spreadsheet, an analysis spreadsheet of how you analyze properties, I mean, do you have anything like that? Maybe a software or any type of tool?
I do not currently.
Not a problem. All you want to do is get one of those tools because it makes you look more professional. Even if you don't 100% understand it, let's say it's spitting out a bunch of terms like NOI and DSCR and all that, and you don't really know what all that means yet because you're still new. It doesn't really matter. It just matters that you have something that makes it look like you're a lot more organized
and actually know.
Exactly. So, because you really only need to know two metrics, and that's, does it cash flow, and how you're going to get your money back at the end of it, which is ROI. And we're going to go into that. That's the last piece to this whole puzzle. So number one, you want that, and you're going to want like some sort of payment plan for your private money lenders. Now, normally the way I pay my private money lenders and hard money lenders back, because we're talking about renovations specifically here, normally you use the BRRRR strategy. Are you familiar with that?
No.
The BRRRR strategy. Okay. So I want you to type this in, BRRR strategy. Okay. So just type that's, if you could walk over here with at least three things. One, the Maryland Investor Network Facebook page, join that with your Facebook group. All right. That's a huge tool. That's helped me immensely for here in Baltimore. And of course, anyone watching this, if you're in a different local market, then I'm sure you have Facebook groups for that. Number two, all right, that pro forma spreadsheet. You just at least want that to help you analyze deals. Let's call that a pro forma. Okay. You could probably Google it. You might get some free online versions. Some of them might want your email. I'm not sure. And like I said, I do have it on my website if you want my complex version, but it is a little bit complex. So it might be overwhelming if you're like really new. And then the third thing is, oh geez, I just lost it. No, what was it?
The BRRRR strategy?
The BRRRR strategy. Thank you. Yes. So
I'm taking notes. Yeah.
So BRRRR strategy. Yes. And so the reason you want to learn that strategy, I will admit, in my opinion, it's not meant for beginners. I think it's a little bit advanced, but on a cosmetic renovation, it should be fine. Now, here's the reason why. All right. Let's take a very simple example. All right. Let's say you have a house for $50,000. All right. And that's the price of the house. But let's not get into all the selling costs and all that. Just $50,000. And the house, let's say you have a contractor who says that house is going to cost you $50,000 to renovate. Not a cosmetic, but for the example, let's just stick with that. So $50,000 purchase, $50,000 renovate. So you need $100,000. All right. And you don't have it. So you go to a hard money lender, and that hard money lender says, all right, sure, I'll give you the $100,000. All right. Let's say they pay for it all up front. Really, though, they would give you the $80,000, and then you'd have another private money lender give you the 20. But whatever. They give you $100,000. But then they tell you that in 6 months, you owe them 10 grand. Now, you owe them 10 grand plus the entire loan. They'll tell you that. Maybe in a year, you owe them all of that money. So that sounds really daunting. How do you pay someone back $100,000 in a year? So what you would do, you say, okay, not a problem. You take the 100 grand, you take 50,000, purchase the house, 50,000, renovate the house. And then you, after it's all pretty and beautiful, you notice, because you analyzed it ahead of time, that the house fully fixed up would have been worth $150,000. Okay. So in Baltimore, that's pretty common, actually. Probably $170,000 now due to the pandemic. But now the house is worth $150,000. You go to a bank, like a mortgage broker, or someone to, or a mortgage broker probably preferred, and you'll find a lot of them also on that Facebook page. But you go to a mortgage broker and you say, hey, I would like to do a cash out refinance on this property. That means you want to pull the money out of the equity of the house. All right. And you want to refinance it and have them basically, by refinancing it, they pay off any loans you have on the house. That's that hard money loan that we just talked about. Now, the refinance will only do up to 75%. All right, 75% of the value of the house. So in this example of 150, that would come up to $112,500. That means that up to that amount, $112,000, they will pay off any loans that you have against the property, which is in this case $110,000, because we have a $100,000 loan plus the $10,000 you owe to that lender for that loan. So they pay all that to them. Perfect. You just paid them off, and you have $2,500 left to spare. They just give that to you, and that's tax free because it's not actually income. Now, at the end of that process, you now have a new mortgage on it. But this new mortgage is a nice, good mortgage. It's a 30-year mortgage. They don't expect you to pay it back anytime soon. It's a low interest rate compared to that hard money lender. It's a much, much more favorable loan. Now, you might ask, why didn't you just do that in the beginning? You didn't do that in the beginning because that person would only do it if the house was fully fixed. Right. But in this example, it needed $50K in renovation. So basically, they give you that long-term loan on the product, but now you have a mortgage. So you have a mortgage for like, I don't know, $800, let's just say. But then you can rent that same house for $1,600. So $1,600 against your mortgage of $800. I would highly recommend you have numbers like that, where your rent is doubling your mortgage. And that's so now that strategy, that's a very simplistic way of looking at it, but that is how you often will deal with houses in Baltimore City. That was the second house that I ever did. I did that on a duplex. So bringing it all back, I renovated a duplex. Then I did the burst strategy on it. I did mess it up. I did actually mess it up a little bit. And I ended up losing a little bit of money in the beginning of this process. And you might as well. That is what that $10,000 is for. That $10,000 that you still have and your job, that's what that's for. So a lot of times what I would say is you try to minimize your expenses as much as possible. That's what I did. I minimized it as much as possible, though in my case, I managed to live in my first house for free. And then I could just use the income from my job to pay back my private money loan. So that $20,000 loan I had, I paid it back over the course of 18 months by constantly just, putting money into it over and over and over again, combined with the money I was making from the duplex that I bought and theoretically my first house. So you want to make sure that, you have cash in the bank for that type of purpose. When you accidentally mess up and you need some sort of lifeline, that's what your actual cash is for. Now, that's the hardest part for new investors to grasp onto. Even when they have a lot of money, they always think, oh, I need to use my own money. Your own money is not getting you any far. Even if you had the $20,000, let's just say for that example, $100,000, and then you paid that $20,000. Well, you have no money left for the renovations. You have no money left for any type of mistakes. And what happens if something happens in your life, right? So let's just say that's all you had. And I'm just using this as an example. Well, now your car breaks down. You don't have any money. You just, spend it on stuff. Now, maybe that's just your budget. Maybe you have extra money off to the side. Even beyond that, well, you still don't have any money for the renovations because these hard money lenders, they're going to want to have you renovate it first, and then they're going to pay you back for the renovations. They're not just going to give you $50,000 all front for those renovations, like our example. Does that make sense? Try not to overwhelm too much. Okay.
No, that was a good primer on how to get into this. So this was really helpful. And yeah, you got to learn by doing. And your first property may not go smoothly. So I understand that. And the other point that you raised around just understanding and knowing the financial tools that are available, and loans, and then to tap into your own money pool and use that for those mistakes that may happen down the line. Okay, so yeah.
Trust me, when I had 9 houses, I tried using my own money. I still was using my own money. I still was doing that. And I nearly went broke. I seriously almost went, I don't want to say bankrupt, but I noticed in 1 week I will be broke. And it's because I was using my own money to renovate properties. And keep in mind, billionaires and millionaires don't use their own money. So why do we think we have enough money?
Yeah.
You never will. Yeah. So you have to raise private capital. And that's the hardest thing is how do you convince someone to give you $10,000, $20,000? And, and a lot of people think, oh, it's that rich person, but it's not. It's usually buried in a 401k.
Yeah. And it's also about relationships and how to network. I'm sure you have gotten to where you are now because you're likable, you're approachable, and you know how to get shit done. So
yeah, definitely. Even if you yourself don't find that you are able to get the money, then a lot of times you can go into, I hesitate to say this, but there are some people who form partnerships for this type of purpose. Maybe you yourself are uncomfortable with that. One of my business partners that I work with, they are so much better at getting private money than me. Hands down, much, much better. But they're very bad at renovating. They have no idea of anything of the renovation process. So we formed a partnership. they get the private money. And yeah, I mean, I'm decently good at it, like I'll say, but I mean, like they, throw me out of the water on that one. They can raise like millions. And I'm like, well, I don't know how to raise millions. But basically, yeah, so partnerships is an idea. That's, you find someone who, be careful around it. You want to structure the partnership where it's not a 50-50 arrangement if possible. But there are partnerships out there. And what I would recommend if you want to find people like this is you go to meetups and networking events. This you can find on that Facebook page. There's one every second Monday of the month. And it's a meetup where you find lots of people like yourself. If you look up Baltimore RIA, I hesitate with that one because I think it's a little bit more salesy than the one on the Maryland Investor Facebook page. That one's hosted by a person named Brenton Hess. But yeah, otherwise though, these groups, if you join sub 2 groups, or all these different creative financing groups, you may not know what sub 2 is. All you need to know is that's a new wave of strat. Well, it's not new. It's actually incredibly old, but it's becoming popular by someone named Pace Morby. Long story short, it's just a way to get houses for very low down payments without doing all these crazy renovation strategies like the one I just mentioned with the burr. Okay, and I've done those as well. But ultimately, it's just going to be a lot of learning. I won't overwhelm you with all the details of all of that, but joining these groups, getting involved with them is how you're going to find these private lenders, because there are a lot of people who want to lend money. They're just looking for people who know how to do this, or at least seem confident enough. That's, to be honest, remember, a lot of these private lenders, they don't know how to do it. So if you just sound confident, they're going to go with it like most of the time. So
confidence is key. Yeah.
So hopefully that wasn't an information dump. I mean, if you can grab anything out of that, just be aware, once again, driving back home that first point of make sure your second property is safe, that the rent is doubling the mortgage, maybe a duplex or maybe some sort of voucher tenant, something where that rent line is pretty secure, because that second, third, fourth house, those are the ones that'll take you down pretty quick. Believe it or not, like it's easier when you have 100 houses, because if one house stops paying, then it's like, whatever, these 4 will come in. Like, it's, you don't really care, that much. And so,
and I fully understand that, I'm not going to get rich quick by one property or a second property. So I definitely understand the time and the investment that's needed for this. It's just, how do I take that first step and to build that portfolio in the future?
All right. Well, what I'm going to do is we'll have time for one more question off the recording. So anyone who decides to join this Zoom chat and do a free episode, yes, I will answer one more question, usually offline, and we can talk about it. So here, I'm going to go ahead and end the recording now. And but for everyone else, we'll talk to you all really soon.